Hi, welcome everyone to this special episode that we called Gone by Dawn, a special fireside chat with Alex Yokum from CFRA. And this chat involves discussions on various topics around the bank collapses in the US, specifically the Silicon Valley Bank. Hey, Alex, thank you so much for joining us on a short notice. And our audience would love to know you more. So, why don't you start with an introduction?
Yeah, I really appreciate you having me on. I wish it was in better circumstances, but you have to take what you get. Um, a little bit about me. I grew up in the United States in North Carolina, which is about midway, and there I went to NC State. And probably the highlight of my university was I actually went to Singapore for half a year, and I studied at SMU. So that was a really great experience. I really enjoyed the Singapore people, some of the best food in the world. Absolutely. Great experience for sure.
Absolutely. And you have won over our Singapore audience, which is like the biggest part of our audience. So on a work perspective, what do you do on a day-to-day basis, etc.? So, and how do you go about doing things?
Yeah, so I work at an equity research firm. I cover regional banks. Is my largest group of companies that I follow. And yeah, so on a day-to-day basis, I'm looking for updates, trying to value the company. I'm writing any report about the company when there's a material change. And then we also have we write these longer reports where we just kind of do like a deep dive into an industry to see how industry trends have been changing. Maybe like look at how is fintech impacting banking. Maybe something with buy now pay later, is that having any impact? Something like that. And then a couple times a year, we write these deep dives into any subject that we find relevant. So you might be able to guess what maybe my next piece will be on. Previously at the beginning of last year, for example, I wrote one on regional banks and how I thought a rising rate environment would impact banks, and if they would become more profitable, less profitable, stuff like that.
Absolutely. And once we talk about regional banks, so one that has been talk of the town for not like good reasons is Silicon Valley Bank. So before, there's been a lot said, and a lot of everyone is an expert on banking in these days on Twitter and LinkedIn. As soon as the collapse has happened, so what we do want to hear from you is, first of all, let's build into this rather than just get into it. How did the bank even get here? How did it become such a preferred partner for the VC and the startup world?
Yeah. So, until really just a few days ago, they were a very respected bank. So Silicon Valley Bank was the number one go-to for venture capital and private equity. So they are in California, in the Bay Area. Almost all of their clients are in the Bay Area. So that is a little bit of a, it's very concentrated. Everybody knows each other, and they were sort of the go-to. People have said that other larger banks were less likely to understand the needs of these early stage companies. So they really liked banking with Silicon Valley Bank because they really understood the ecosystem. And yeah, in general, their clients really did like them.
Okay, so that is great. So they understood the ecosystem much better. They understood the client's problem much better. So, and from what I understand, they were growing quite well in 2020 and 21. So what was behind that growth? How that changed in 22 and 23 now?
Yeah. So, even before 2020 and 21, they had pretty strong growth. But once interest rates fell, they fell to zero in 2020, and the long, on the curve, long dated interest rates fell pretty significantly. So what that means is for startups, it's less important about what money you make now and more important about what money you'll make in the future. So all of a sudden, every startup can pitch an exciting idea about what they'll do in 10, 20 years, and people want to value them a lot. So in 2020 and 2021, all these, early stage companies really grew in value. And it was great for Silicon Valley Bank because they banked with them. So if they got a new round of funding where their valuation doubled, then they would take those deposits, that extra cash, and just put it in Silicon Valley Bank. And because interest rates were low, and because other banks didn't necessarily want to associate with those clients, because you have to remember, early stage companies are risky. Other banks didn't necessarily want to deal with these companies, but Silicon Valley Bank did. So these companies would put their deposits with Silicon Valley Bank, and they didn't really have to pay out much. So that the rate they paid on deposits was very, very low because they didn't have really other options, and interest rates were so low anyway. They didn't, it didn't matter that much. So in 2020 and 21, they grew extremely quickly. They more than doubled in size, and they got a massive amount of these deposits, like I said, and they started investing them. But because it was a low rate environment, if they did short-term investments, they wouldn't really get anything back. So they decided, okay, we'll go a little bit farther out on the yield curve and invest there into safe government securities. At the time, people thought they were safe investments. And even then, though, it's not like they were getting 5% returns, 7% returns. They were getting less than 2%. So it is a decent amount of risk in hindsight for not that much return. But in 2022, the environment changed. So that is when the Federal Reserve in the US started to raise interest rates. And that totally changed the environment for their clients. Because all of a sudden when rates go up, like I was talking about earlier, where if you make money in 10 years or 15 years, that's fine. All of a sudden, not so much, right? Time value of money, you want the money now, the higher interest rates are. So the client, all of a sudden these valuations started falling. And no startup wants to have a new round for a lower number, right? You always have to have growth, growth, growth. You never can shrink, right? That's like rule number one. So these companies stopped getting new rounds of funding. They stopped IPOing because they would go for a low valuation. Acquisition slowed down because nobody wanted to get acquired for a low number. So these companies with all these, they had all these deposits from 2020, 21, massive cash, they slowly started spending it. And that shows up for Silicon Valley Bank in their deposits. So the deposits slowly started ticking down. And for a while, that was fine because it was a slow decline, and most banks can handle a slow decline in deposits. But 2023 comes around, it continues, rates continue to rise, and all of a sudden, the securities portfolio, which we had mentioned earlier, starts becoming a bigger issue because these long-dated government bonds start falling in value because of rising interest rates. And I'll just use a quick anecdote here, like a little story, so you can help visualize it, because I think the concept can be a little bit difficult. So this is one way to view it. This is not a perfect analogy, but I think it's kind of close. So think about Silicon Valley Bank. Let's say that they were buying investments for $100 in 2020 and 2021. And let's say those investments returned $1 a year. So every year they would get $1 from those investments.
Yes.
And because all their clients were doing very well during that period, they bought a lot, right? Other banks also bought these investments, but their clients didn't grow as quick during this period. So they bought some, but not a lot. Silicon Valley Bank bought a ton because they had all this extra cash. They wanted to get some return. So they buy these investments that, let's say, return $1. Then in 2022, and by the time 2023 comes around, let's say there's new investments that are exactly the same. The only difference is now they pay 4%. So previously they paid 1%, now they pay 4%. And normally higher return, higher risk, no. Exact same risk, exact same investment, but now they pay 4%. So you got to think, if you're someone else, would you rather an investment that pays $4 a year or $1 a year, right? You want the one that pays 4. So that's basically what happened to them. They had a bunch of these investments that paid a little bit. And then because rates went up, now everybody else can get 4. So the value of those investments fell significantly. And the reason why it was unique again to them is because they grew really quick during that period. So they invested a lot at the wrong time. And in general, also, they tend to lend a little bit less than other companies. You really usually only get loans if you have cash flow and can pay them back. VCs, they're not really having a cash flow. So they just, they have new rounds of funding. So they had a high proportion of these securities compared to loans versus other banks. So a lot of things working against them. And in the beginning of this year, they started to realize their portfolio was really underwater. And because those deposits were slowly coming down, nobody was getting new funding rounds. Just they were running out of cash. And all of a sudden, when people say, okay, I need to pay my employees, Silicon Valley Bank, do you have the cash? They didn't. So what do they have to do? They had to start selling those securities. Like I said, unfortunately, they were now underwater. They were worth less than what they bought them for. So they had to book a loss, and they booked a $1.8 billion loss. And this would have been last Wednesday. So so all of that took years, and then this starts happening really quickly. So this was on Wednesday. They booked a $1.8 billion loss. And to put that into perspective, that is more money than they made in the entirety of 2022. So they booked a significant loss.
Yes. Yeah.
And investors were like, whoa, what is this? Why do you have to do this? Like, what's happening here? And then they had to raise capital because they needed to, continue to pay people. And investors got really worried. And it was terrible timing. This is just bad luck. They couldn't have known this. The same day that this happened, Silvergate Capital, a smaller US bank, goes bankrupt.
Yep.
So really bad timing. A lot of things working against them. Definitely you could definitely argue bad risk management. You shouldn't be buying low return, high risk investments. Well, they're not high risk, but they ended up being high risk, but because they bought so many and didn't hedge them. But really bad timing with the Silvergate. Again, that was a much smaller bank catered towards crypto, but once people start thinking about default, it can spiral quickly.
Absolutely brilliant answer, Alex. So you've given me some really good points there. I want to go into this one layer at a time. Now, so the first thing I want to ask you is, you talked about their securities portfolio. So how was this different from some of the other banks? And they hold something called HTM and AFS, right? So could you help explain to the audience how these portfolios are different and what happens when you try to sell an HTM portfolio?
Yes. Okay. So I'll try to keep this as simple as possible. It is confusing, but so the main reason why they're different is what I was talking about, where they don't do as many loans as other banks. So that's why they had more securities. Typically, a bank would rather give out a loan than invest in investment securities because loans have a higher return.
Yes.
So typically, you want the higher return, but if you can't give out loans, you don't want to give out risky loans. So instead of giving out, risky bad loans, you'll invest it in investment securities. So that's why they had significantly more. Whereas other banks, they deal with later stage companies or even, individuals who aren't mortgages and that type of thing. So they can give out more loans. But, before this, that wasn't necessarily considered a bad thing, but it ended up being a bad thing for them. But in terms of their securities, you're right. So there's AFM, which is available for sale, and HTM, which is held to maturity. So this is really just an accounting, a way to view it from an accounting perspective. So securities that are available for sale, from an accounting perspective, banks have to show the loss on those. So if interest rates go up, they have to show what loss they incurred. And that's the portfolio that Silicon Valley Bank ended up actually selling. They wanted to get rid of that. The other one is held to maturity. Those are securities that banks buy that they have no intention of selling, and they just wait until they mature and they get, they get money from it. So banks typically don't sell them, and if they do sell them, they have to mark down their entire portfolio. So if they sell one HTM security, they have to tell everybody in the world how much money they just lost on the entire portfolio. So banks do not want to do that. It's a bad look, and it makes them look more risky than they want to appear. So Silicon Valley Bank had a pretty big loss in their available for sale portfolio. Like I said, 1.8 billion, that's equivalent to, more than 2022 earnings. However, their held to maturity portfolio was a $15 billion loss, which was more than the entire value of the whole company. So once people started realizing, they have a loss that's worth more than the entire company, we need to sell. And people start selling. And once investors start selling, Silicon Valley Bank, they are a bunch of very intelligent people who are all working together. Once one person starts getting scared, they tell their friend, they tell their friend. Like the magnitude was on Thursday. So remember, just one day after Wednesday. On Thursday, a fourth of their deposits were attempted to be withdrawn. That's how quickly it spread. Everybody's telling everybody, take out your deposits, take out your deposits. And no bank can handle a fourth of its company trying to be withdrawn in a day.
No, absolutely. I think, when we look at how this bank run went through, there was digital technologies, social media, everything played into the frenzy. And, when you have very respectful names in the VC industry come out and say, we have asked all our portfolio companies to get out of Silicon Valley Bank, I don't think it really helps anybody's cause when in the digital bank run. So that is that in itself should be another podcast. So yeah. So was because they were not mapping their HTM portfolios to the actual value. Was this also a reason that nobody saw this coming?
Yes, before this, like I said, typically banks never sell them off. So it's that people are aware. It's in the 10K. You can find the HTM. You can see what the loss is for HTM and AFS in the 10K of these companies. But before this, people just assumed that they could wait it out because remember, even though there's an apparent loss, if you just wait until maturity, there's no loss. So that's typically what's always happened in the past. And it was really because they invested so much at such a low rate. And honestly, interest rates have increased at one of the rapidest rates in American history. This hasn't happened in decades for rates to go up this quick. So if even that hadn't happened, they still would be fine. So I think definitely bad luck, but it's not just bad luck. I mean, if you're a risk, banks are supposed to be risk averse. They should be thinking about what happens if rates go up above a certain point. It's not like there's no hedging vehicles available. Banks can hedge their portfolios, and they didn't do that.
Right. Yeah. And I think just giving a fair assessment here is that I don't think anybody could plan a bank for a digital bank run where a fourth of the portfolio, as you mentioned, will go out in a few hours. So I think it is very difficult, and I think risk managers, everybody now need to look into a very different way of managing their risk. So what happens if everybody comes at like one single point and want to ask for their money back? Because this is not like an old bank run where it took like 15 days to release 18 billion or something. Yeah. So this is very fast. You have to really see that in that perspective also, that what do you do? No.
Yeah, I'll just add to that because I think that's important. Yeah, so you're definitely right. Yeah, previously bank runs, if you're telling your friend, it just takes longer. And Silicon Valley Bank or their customers are all on Twitter all together, and Twitter's hyperbolic, and you're seeing images of people outside the bank. They can't get in. The website's down, and it just spreads like wildfire. So I think that's important. But also to add to your previous statement, so people look for risk in banking, obviously, but typically, including that's what's looked for by the government, is typically more focused on credit. So when people are usually concerned about banks' ability to be an ongoing concern, they're typically more worried about are people going to start defaulting on their loans, and will the bank be able to handle that? So that's one reason why it was in plain sight, but not necessarily top of mind for people, because there've been a lot of talk about the United States are going to go into a recession, and people have been really worried. They're looking at the loan book. Are the loans safe? Are the loans safe? And the thing is, their loans actually aren't that bad. It's not like the people were defaulting on their loans that much. That wasn't the issue. It really was just a mismanagement of duration on their securities portfolio.
No, and absolutely. I think in hindsight, we can sit here and say this was like, a mismanagement, and, we can, there is a lot to learn from here. But at the same time, I think they were also blindsided by how quickly everything will move. And, so that played its part. Now, one of the other factors that was very critical in this was how, Silvergate Capital collapsed right before, they were making their announcement. So just want to get your quick thoughts on what happened there and how did it accelerate what was happening at the Silicon Valley Bank?
Yeah. So I touched on them a little bit, but yeah, just to add a little bit. So like I said, they were a crypto-friendly bank. Not many banks wanted to deal in crypto. It was, a new industry. It was something that very few banks dealt with, and they were one of them. And like I said, not that many banks wanted to deal with venture, early stage, especially early stage, because they're very risky, early stage companies. So Silvergate dealt in crypto, and so all of both Silvergate and Silicon Valley Bank, during 2020 and 2021, very strong performance from a stock perspective, right? Strong growth from a balance sheet perspective. Things were looking good, but they had a similar issue because last year not only did VC and private equity struggle, crypto also struggled, and the blow up of FTX, and then several other companies went down in 2022 for crypto. That was not that was perceived as dangerous, and Silvergate started to see deposit outflows actually at a more rapid rate than Silicon Valley Bank. So Silicon Valley Bank, their deposits weren't necessarily down that much before this happened.
Yeah.
They were down, but not a really significant amount. Silvergate's, their deposits were down more than half. So it was a really, really big fall down. And yeah, I mean, they struggled from actually a similar situation. They had securities because, again, they had extra cash. They put in securities underwater. People want to take their money back. They can't give it to them. They need to get rid of their securities. They book a huge loss, and they can't sustain themselves. So actually a similar thing. And like I said, I think the fact that they happened on the same day really just added to that Twitter frenzy. Oh my gosh, the banking system's going down, just really hyperbolic, just fear. And the problem is, it's really unfortunate from a banking perspective. But if you're a startup, I mean, I can't blame them for wanting to move their money. FDIC insurance is only $250,000, and businesses don't have, they have millions. So if you have $10 million, okay, you keep 250. That's not great. So just from a risk management standpoint, I really do understand why. I definitely understand why people got worried and wanted to move their money. Yeah.
No, absolutely. And now let me put you on like a tricky note here.
Okay.
And see, a lot of this comes back to Twitter frenzy. We have had that word, and I saw that myself as well, that there is a lot of that happening here. Do you think there should be an investigation of this bank run based on the Twitter frenzy? Because this has basically collapsed a bank, which then the whole industry came out and they said, this bank served us for 40 plus years. This is our lifeblood, and this needs to be saved. And in the first place, the industry itself caused this bank run. So, how does the regulator look at it? And should there be some kind of communication on some kind of regulation for these kind of communication on social media?
Well, you did say the industry itself caused its own bank run. So in that view, the only people to blame, were it was a little bit self-inflicted. It was a problem. I mean, like their portfolios were underwater. But it was a self-fulfilling prophecy. If so many people hadn't thought it was going to happen, it wouldn't have happened. So I probably wouldn't have any restrictions there. I think it's always good to spread information. It is unfortunate if it causes, stuff like that to happen. But in general, I'm pretty pro the spread of information. I just sometimes wish that people would, look, just be a little bit better at analyzing what's good information and what's bad information.
Absolutely. Okay. And now you're not off the hook. Now I want to ask you a second tricky question. Okay. Because, crypto has come up in our discussion. It is always a polarizing topic. But one thing that, everyone is talking about, at least here in Asia, is that Signature Bank, which was also shut down by the New York authority, was not necessarily insolvent.
Yeah, I feel kind of bad for Signature Bank. I mean, they were a strong bank, so they should be viewed differently. Signature Bank and SVB were strong banks, and generally, just considered good, strong banks. Silvergate, they were definitely more of a risky play. They did go bankrupt, but I wouldn't say that was a surprise to people. The industry had been doing bad for a while. People knew that they were making a gamble on a a dangerous industry. So it was sad to see them fall, but it wasn't necessarily a surprise. Whereas Signature Bank was an established bank, and they were a little bit more careful with their risk. So Silvergate, they had a vast majority of their deposits in crypto, whereas Signature Bank, they were a little bit more careful about it. They only had a fourth of their deposits in crypto, and by the time they went down, they gave an update right, a few days before they went down, and they were only 18% of their deposits were crypto related. So it does feel like it was a little bit of an overreaction with them, but there were still outflows. So I know what you're referring to. There are talks that maybe they got shut down too quickly, but I believe I still heard that they had 10 billion deposit outflows, which is still pretty significant. And so there was definitely fear. And I think they have a similar problem to Silicon Valley Bank in the sense that their customers are often in the same place. So a vast majority of their customers are in New York, different city. But whenever people are in the same place, I think you're more likely to tell your friend. If all your friends are on social media, like we talked about, if everybody is getting worried, you'll react much more than if you see one post or two posts about it, if everybody's talking about it. So there were outflows, and like Silicon Valley Bank, their business model was struggling. They had seen deposit outflows before this. So in a similar sense, in 2020 and 2021, their customers had a lot of extra cash that started running out. So they saw deposit outflows as well. But to your point, yeah, I think it is possible they were shut down a little early, but it is a little hard to say.
Yeah, no, that is a fantastic answer. I think you're being very candid on this. So, one thing, whenever a bank collapses or something of this sort happens, there is a direct comparison to 2008, and there's like, is this the Lehman moment, or is this an extension level event of the Silicon Valley, etc. Now, I would like you to share your thoughts. One, is it the 2008 moment of the banking industry again? If not, then why do you think so?
Yes. So if I want to make anything clear, this is what I want to make clear. I do not think that this is similar to 2008 financial crisis. And the main difference is, like I said, typically investors are worried about credit quality. And that's what 2008 was about. If the economy is going down and people are defaulting on everything, credit cards, mortgages, their cars, if people are defaulting on all these things, it's dangerous, because if one bank goes down, everybody's loans start going bad in a similar time. To me, that is more contagion risk. So you can see it spread around the economy because banks are so interconnected. This is, they weren't making speculative bets here. This is important, right? Risk management was bad, but remember, these weren't risky loans that went bad. These were investments in safe bonds that they managed the risk wrong. So I would say the real fear here that potentially could have caused a 2008-like moment would have been if there was bank run after bank run after bank run. But on Sunday, the FDIC and the Fed tried to stop that. And I think, so what they did was so typically, like I said, deposits are insured up to $250,000. And for Silicon Valley Bank, only 5% of their deposits are up to $250,000. The rest, 95%, were all at risk. So you can see why people would get worried. And then Signature Bank, 90% of their deposits were at risk. So again, you can see why people were worried. But on Sunday, they said that those two banks, their customers would be made whole. So both insured and uninsured deposits would be made whole. And I think given that those two banks are a little bit more innovative, a little bit more in innovative industries, that sort of set the precedent that if a safer bank went down, their deposits would also be safe. So that was the attempt. You don't necessarily now need to take your money out of a smaller bank, because if it goes down, the government will likely, keep you whole, and you won't lose money there.
No, now let me ask you another tricky question here, because this has really been bothering me, and I think.
Okay.
So when they made the deposits whole, So
Yes.
that means that even if you had $1 million, they will back, FDIC would back $1 million. So is the FDIC insurance unlimited now? Or is that, like, what are your thoughts on this? Because this seems like a very tricky spot to be in. You want to, I, I get it why they did it, because if they don't do it, then everybody starts moving money out of regional and smaller banks into bigger banks, and then there's not only a bank run, but there's also a concentration risk. But
Yes.
at the same time, now does this send the message that FDIC insurance is unlimited amount of money? You can put in any amount of money, bank goes back, we'll cover it for $1 billion, 2 billion, any number, right? So what are your thoughts on that?
So yeah, you're right in the sense they need to be very careful. I hope that once this improves, they get rid of that. I hope that's not continuous, because I do think that could cause some issues. Maybe some banks would be a little bit more dangerous than they would otherwise. But I think it's very important to point out that the equity holders were not bailed out here. They were not made whole. So if you owned part of the company, you lost everything. Well, I guess we don't know if they lost everything yet, because the bank could still be sold, maybe if assets are sold off, but there's a good chance you lose everything. So they wanted to make it very clear that equity holders will not be made whole, and even potentially some debt holders will not be made whole. So if you think about investors who are, trying to make an impact on management, if management is making risky bets that will keep their customers safe, but not their equity holders, well, then people won't invest in the company. So I do think that was important that they actually did not bail out the equity holders, to send the message that if a company makes a bad decision, the shareholders are going to lose money.
No, absolutely. So I get that perspective, but there is a moral hazard here that
Yes, there is.
and
there is.
that is a little bit worrying. That how do you stop something like this? Now, there is also a lending facility that has been opened by the Fed and FIDIC for all of these banks. So could you walk us through how that works, and how long do you think it will have to go on?
Yes. So that lending facility gives banks the opportunity for, it gives them like a 1-year loan, basically. And the important part about that is, so I was talking about how SVB, they had the securities portfolio, which was underwater, and that's what caused, a good portion of the panic. Well, they're not the only one, actually. Like I said, they had they got more deposits during 2020 and 2021, and they invested more than other banks at a bad time. But other banks also got deposits during that time. If you recall, during that time, the United States had mass stimulus. So in general, the banking industry actually got more deposits than they typically get. And they also invested them. Not as much, but they still did it. So the entire banking industry is actually down, many hundreds of billions of dollars on these portfolios. It's spread out, but a lot of banks have pretty significant unrealized losses. So what this does is allows banks to basically use that for collateral, their securities portfolios. But the important part is they get to assume that they're at par. So if a $100 investment was now worth 90, they can still use it as collateral at 100. And what that does is it makes it so if they have deposit outflows quickly, they can borrow money without having to sell the securities for a loss. That's the key. As long as they don't have to sell it for a loss, you don't get that big. If you don't actually have to write down the loss, if you don't have, if the loss doesn't actually go through, then it's not as big of a deal.
Right. And how long do you think they will have to support? They call it the BTFP, the bank term funding program. How long do you think they will have to run this before things get back to normal?
Again, I hope it's short, because similar thing. The longer it goes on, safety is like that. You wish it was self-regulated, right? You wish banks made all the decisions themselves. So I think the more safety blankets you give, in the long run, that is dangerous. So I hope once fears about bank runs, come down, I really hope they don't keep that up, because I think it's dangerous.
Yeah. And one of the things we were talking about is that the final sale of SVB or Signature or some of these banks, Now in the UK, we have seen HSBC take over the SVB UK operations for £1. And why haven't we seen anyone buy SVB in the US?
Yeah. So this is actually one reason why. So Monday was a pretty big rout on banking stocks, and this is one reason I think why is so Friday comes and Silicon Valley Bank goes down, and if you recall on Wednesday, Silvergate went down. So two banks go down in 3 days, and so people are really scared. On Saturday, I hear stories, anecdotal stories, that people are outside of bank branches, trying to get their money out. Especially in California, near where SVB, was headquartered. But so on Sunday, people are looking for an acquisition because if they're acquired, that brings some stability to the system. It's more likely that people will get paid. At that time, people still didn't know if uninsured depositors would get paid. So people were really hoping that they would get acquired so that uninsured clients would still get their money back. So we're looking for that headline. We're looking for, SVB acquired by X. Instead, we get the headline PNC not interested. That's a large regional bank in the UNC in the USA. So we get this headline, and then right after that, we get the headline Signature Bank goes down. So people are like, oh no. So that's, and then the other positive news came out about the uninsured. But I think there was a lot of negativity going into Monday. But in terms of why were they not actually acquired, and there have been talks that they've tried a second round to see if anybody's interested in acquiring them, and it hasn't happened. Let's say a few reasons why they haven't been acquired. One reason is, like I said, they're lending to people that other banks don't necessarily want to lend to. They're banking to people that other banks don't necessarily want to bank to. So other safer, or not necessarily, other safer banks don't necessarily want to pick up this risky client base that they don't understand. There's some risk there. And with the mass deposit outflows, banks aren't necessarily confident that they're going to keep these customers in the long term. So, there's definitely concerns there. But a larger concern is this was a large bank that went down. This is the second largest bank that's ever gone down in the US. And Signature Bank was actually the third largest bank that ever went down in the US. So yes, 2008 was obviously much worse, but from just a asset perspective, these two banks going down is somewhat similar to the total assets of all the banks that went down in 2008. It's actually pretty similar. So because of that, Silicon Valley Bank is the 16th largest bank in the United States. So, realistically, how many banks can actually buy them? And when you go through the list, almost all large regional banks couldn't acquire them because they just had acquisitions. They have just gone through large acquisitions. We're not talking about small acquisitions. We're talking about game-changing large acquisitions. So they don't necessarily want to have another acquisition that soon. And then at the top, there is concentration talk. So J.P. Morgan, largest bank in the U.S., maybe not a good look for concentration and fears of too big to fail if the largest bank in the U.S. picks up one of these banks. And if you go through the list, other banks have they've just been getting in trouble, getting fines. So there's really only a couple of banks on the list, and like I said, a little bit risky clients. They're not totally sure about how the deposits are going to play out. They just weren't interested at the time. So you're right, though. People were expecting it, and it didn't happen. So that, I think, did cause a little bit of concern. Yeah.
No, and so, this brings me to an observation. In the first place, because the VC and the startup industry is actually considered very, very risky. So that is why nobody was banking them. So there was a concentration of them with Silicon Valley Bank. So that is where, this whole thing happened. Now, since Silicon Valley Bank is gone, the industry, the VC and the startup industry is again in this place where nobody would want to bank, or there are higher costs of banking with them. Do you really think the VC, tech, and crypto industry in particular will be debanked?
Yeah, so this is a good point. I obviously Silicon Valley Bank went down. There were some issues, but I do want to give them some credit as well. It wasn't just that they were the ones that were willing to do it. It was also that their clients liked them. They gave better services. So their services were more tailored. Their clients thought they understood them more than larger banks. So that, I think, is worth mentioning as well. But yeah, unfortunately, this answer is a little bit negative. I do think this is bad for innovation in the United States. I don't think it's a good look that banks that were willing to take a little bit of a risk on new industries with crypto, on startups, in venture capital. I don't think it's a good look that the banks that, went into it, strong, they went down. So unfortunately, other banks, you could even argue logically from a risk management perspective, they're probably not going to bank, as many of these industries as they would have otherwise. And if they do, maybe they're going to charge more or, give less good terms because they view them as more risky. So why would you give them such a good deal? So unfortunately, I think it will be a little bit of a hit. Now, it would have been a lot worse if the news hadn't come out that the uninsured depositors would be made whole. Because on the weekend, like I said, there was a lot of fear. And part of that was all these companies, well, not all these companies, a lot of these companies had all their money with Silicon Valley Bank. And they were worried that they weren't going to be able to hit payroll. So on Friday, companies were coming out with how much money they had at Silicon Valley Bank, and we would see some stocks just falling with the announcement because there was the assumption that they would potentially lose that money. But yeah, a lot of companies had all their money with Silicon Valley Bank, in part because I said it was one of the few banks that these they felt like understood them. Yeah.
Yeah. So, and this has been a great discussion. We are coming towards the end of the discussion, but I have a few more questions for you before I let you go.
Yeah,
One
absolutely.
is, are we out of the woods? Are there other regional banks or other like national banks, etc., that could be in trouble as well? And how do you look for trouble now that we have seen one of these? So how do you look for trouble? What are the characteristics, etc.? Could you walk us through your thoughts on that?
Sure. Okay. I think there's a decent amount to unpack here. The first thing I would say is I still think regional banks, are staying. It's not like everybody's going to leave to the big banks, and that is because I think regional banks do give a good customized product. They're more likely to understand your needs. Maybe they'll give you better rates on your deposits. I think they serve a purpose. They keep competition. I do not think it would be good if we just had a bunch of mega banks. That being said, regional banks in general, I think this is going to hurt, and maybe even large banks a little bit too. And this is why. Before this, we were talking about deposits. Deposits felt a little bit a dime a dozen. Banks always want deposits, but banks in general had far more deposits than they had before the pandemic. So they still wanted to keep them, but they weren't that concerned if they lost some because they had so many. Now, given what's happened, banks want to keep their deposits. And one way to keep your deposits is to pay more money on your deposits, because some people, you'll move to a different bank that pays you more on your deposits. So I think the entire banking industry is going to have an increase as they fight more to keep their deposits, and that's going to impact profitability. So that's one thing to look for. I think a lot of people see a couple banks go down and then look for buying opportunities. Let me buy all these stocks that are down. But I just want to caution people to realize that the profits might be a little bit less going forward. Also, banks maybe slow down a little bit on lending. They just want to reassess. They want to just make sure we're okay. So maybe lending will slow down a little bit. Maybe there'll be more regulatory costs, right? So there have been talk maybe that if Silicon Valley Bank was more regulated, this wouldn't have happened. So maybe there'll be more regulatory costs going forward, which would also decrease some profitability. So I think that's worth mentioning. In terms of banks that are potentially a concern, that could underperform or even in the worst case, go down, which I think is less likely now, given that lending from the Fed and given the fact that uninsured will have been made whole, at least so far. I think less likely. But if we're looking for banks that potentially could be at trouble, I would say one is concentration risk. So are all the deposits in like the same city, sort of like Signature Bank and SVB, just because of, like we talked about, social media, it can spread more. That can be dangerous. Business, if you have a lot of business customers, I think they're more likely to kind of herd because everybody's paying attention, talking to each other more. If you just have $2,000 in your account, maybe you're less likely to move your money. But if you have millions, you got to be on top of it. You're more likely to move your money. um, Wealthy individuals. So if you have a lot of wealthy clients, maybe they're more likely to move their money for a change in interest rates. Again, if you have $1,000 and the interest rate goes from 1% to 2%, okay, $10. But if you have 100 million, well, that's $1 million or $2 million. That matters. That's worth your time to move your money. So wealthy clients are known to be a little bit more interest rate sensitive and more likely to move their funds. I also think they're more likely to move in a bank run because somebody's probably more likely telling them, you got to move, you got to move. So I think that's a little bit risk. So banks with large retail clients that aren't necessarily super wealthy, I think are a little bit safer from that perspective.
No, absolutely. That was a very, very nice answer. And before you go, a last tricky question.
Okay.
So, everybody's talking about how the velocity of the interest rate rises in the last, few months, etc. Now, Fed was all like there were expectations that they will raise the rates by 50 basis points before this happened. Now the expectation is anywhere between 50 basis point raise to a 25 basis point cut. So what do you think the Fed will do? Take out the magic crystal ball and give us a projection of what do you think will happen with the interest rates. Are we going into QE? Are we going into QT? What goes on from here?
Okay, so I will answer this, but I just want it to be stated that we are taping on Wednesday, and this changes every day. So literally, if you've looked at this every day that the market's been open, it has changed very significantly. So based off the events, my answer could change pretty quickly. So just want to state that. For example, today, Credit Suisse started having some trouble. People started getting worried about Europe. So that had a serious impact. So I'm stating based off what is the current knowledge. But if another bank goes down, I think that could definitely change. Currently, though, I would say 50 basis points is probably off the table. I do not think that's going to happen. A cut, I also think, is a little bit unlikely. That would, I think, send a bad message about inflation. So I'm going with 0 or 25. And if nothing else bad happens from now until the meeting, I would lean towards 25. But if we get some more negative news, which I think is somewhat likely, then 0 is on the table. But it's worth mentioning, we've talked about rising rates and how that's had this negative impact, but we have to remember, in general, rising rates are actually good for banks because in general, they charge more on their loans, and they typically, at least in the past, haven't raised the rate they pay on deposits that much. So typically, for every percent that rates go up, banks make more money. So last year, when rates were going up, in general, banks actually started making more and more money. So falling rates will actually be bad in net for banks from a revenue perspective, at least. So that's worth pointing out. But in terms of my projection, I would say that the Fed is looking at unemployment and price stability. Unemployment is still really strong. There have been headlines about tech layoffs, but we have to remember that is a small percentage of the U.S. economy, and in general, unemployment is still quite low. And even people that do get laid off, it's usually somewhat easy to get a job. There are actually more job openings than job seekers. So it's not that difficult right now, at least from an historic perspective. So if you're sitting there and you're the Fed, and those are your two things you're trying to handle, I would be a little surprised if they cut quickly, just because inflation is still 6%. That still needs to be handled. That is much higher than their 2% target. And unemployment's so low that they have a little bit of room there. They don't have much room with inflation. So I think they might be a little bit more hawkish than is anticipated right now. People have really started to discount the future. And I think that could be a little bit dangerous because you do not want inflation to get out of control and get rooted in the economy. that's where you get in real trouble. That was the US in the 70s and early 80s. And that is not something that I don't think anybody wants.
No, absolutely. And I think that, this has been a wonderful episode. Thank you so much for being so candid with us and joining us on such a short notice. I just want everyone to know that, Alex agreed to doing this in like one business day. And, we got everything together. This has not been a like usual episode that, we get a long time to plan and then market. So I really thank Alex and the team at CFRA to, come out and, do this episode on such a short notice. And, I hope everyone has enjoyed this episode as much as I did. And thank you so much for joining us.
Yeah, I really appreciate you having me on. This was a lot of fun. I appreciate it.
Thank you.